Hello. Okay, everybody. Welcome. Good morning or good afternoon. Welcome to the BDO Financial Reporting webinar. My name's Rob Carter. I'm going to be joined today by my colleague Moses Surfety. We both work in the financial reporting technical team here at BDO. Just a reminder, the recording of the webinar will be available for you to listen back to later. So just in case you have any technical issues throughout the webinar, you can always listen back to that. In terms of asking questions throughout today's webinar, there's a Q&A function which you should see an icon at the bottom of your screen. If you could please use this this means to contact us if you ask your question. We'll either try and answer it during the webinar or at the end of the webinar if we get time, or alternatively we'll come back to you with an answer later on. In terms of today's webinar, it's going to last approximately about 45 minutes or so. And moving on to the kind of an overview of what the topics are that we're going to cover. Firstly, we're going to look at, which should hopefully appear on the slide in just a second or two. Firstly, we're going to look at an overview of IFRS and UK GAAP updates. So we're going to have a look at any updates that have happened over the last few months in terms of new amendments that have been issued to standards. We're also just going to have a little bit of a reminder of the financial reporting regime in the UK following Brexit. We touched on that previously back in our December webinar, but there's been a few updates and bits and pieces that we're just going to cover off as part of that. I'm then going to hand over to Moses, who's going to take you through some narrative reporting updates. So firstly, focusing on climate related reporting matters, which again, we've covered in previous webinars, but is very much kind of a moving topic at the moment. We're also going to touch on some recent publications in terms of corporate governance and best practice approach that can be applied in relation to corporate governance disclosures. And then finally, we're going to finish with some other financial reporting news. So just bringing in a summary of other areas and kind of current hot topics, including government assistance reporting requirements, as well as an update on some judgments in both the High Court and the Supreme Court, and the accounting that might be applied for that, as well as touching on a few other areas such as the BEIS consultations that are currently out for comment. So just before I dive into the IFRS and UK GAAP updates, you'll see coming up on the slide that we just wanted to run through very quickly the FRC focus areas for the current reporting season. If I could just have the next slide, there we go, perfect. You'll see on the screen here, firstly in the left-hand box, you've got a list of the corporate reporting thematic reviews that the FRC is going to be completing this year and should be issued towards the end of the year. So this just gives you an idea of obviously the current hot topics. Probably no surprises there for anybody in terms of some of the items that have been included in terms of firstly going concern and viability, which we've talked about on previous webinars with the COVID pandemic, has been very much at the forefront of people's minds in terms of reporting and the interests of users. Also touching on provisions and contingencies, and as I said, Moses is going to cover some specific aspects of that later on in the webinar. As well as some of the bits around the climate change and SECR reporting as well. They also list there the priority sectors, so these are the areas that they're focusing on throughout the year. So just something to be aware of as part of your reporting. So diving in then to the IFRS and the UK GAAP updates. The first one we're going to start with is probably one of the biggest ones for you to be aware of and something you may well want to be thinking about if you're an IFRS reporter. And this is the amendments that have been announced to IFRS 16 in terms of COVID-19 related rent concessions. So you may remember if you've listened to our webinars before, we covered this in a previous webinar in terms of the practical expedient that was introduced last year by the IASB to IFRS 16. So the practical expedient, just in very short, allowed lessees to account if they met certain criteria for changes due to rent concessions, not have to apply the full modification accounting in IFRS 16 to those rent concessions if they met the criteria. In terms of the amendments that's been issued by the IASB, this changes just one of those criteria. So everything else is unchanged in relation to this, and this is the time limit that was applied for those rent concessions. So the original practical expedient only applied to rent concessions that had an impact in terms of lease payments up until the 30th of June 2021. This meant that if you had concessions that were going beyond that period, they wouldn't be able to apply the practical expedient. This has proposed and now been taken on board an extension to that to the 30th of June 2022. So allowing a further 12 months of use of the practical expedient. The reason for this obviously is the ongoing nature of the COVID-19 crisis. I think when the IASB originally proposed the practical expedient last year, it was perhaps not envisaged that we would still be feeling some of the effects that we are at the moment. In terms of the impact that this amendment is going to have to the practical expedient, it is going to depend a little bit on the circumstances of individual entities and options that they've previously taken. So it's something you're going to want to think about. You'll see on the right-hand side there, we've got a BDO publication which summarises the amendments, and that's available on the BDO Global website. There's a link on the slide which will be circulated, and also there's a link later on generally to the BDO Global website. In terms of those impacts, it's going to depend, as I say, upon the specific circumstances. But just to note, it will be applied retrospectively. So what that means is if you've previously applied the practical expedient to certain leases that met the criteria, and the only reason you didn't apply it for these particular leases was because they went over the 30th of June 2021 date, but they would now be within the new revised date, you will need to go back and be retrospectively adjusting for that in certain circumstances. As I say, the BDO IFR bulletin covers a number of those different scenarios and what the accounting would be. In terms of the effective periods of the amendment, you'll see that's highlighted here on the screen. It applies for periods beginning on or after the 1st of April 2021, but earlier application is permitted. However, it's really important to note that at the moment this has not been UK or EU endorsed. It is expected to be UK endorsed by the end of May. It's on kind of a fast track process, but at the moment it's not been endorsed, and so it can't be applied by anybody that's applying UK or EU IFRS. Moving on from this, we'll jump quickly into UK GAAP for a very similar change. So the FRC announced actually only on Tuesday this week that they are making similar amendments to FRS 102 and FRS 105 related to COVID rent concessions. We covered the FRS 102 and 105 rent concession guidance in our last webinar back in December. So if you want to look at the details of that, please listen back to that. Similar to the IFRS change, this only changes the one criteria, which is around the date of application from the 30th of June 2021 through to payments up until the 30th of June 2022. It's important just to note that the actual rent concession practical expedient in FRS 102 is different to FRS 10 to the IFRS one, in that it is, if you meet the criteria, it must be mandatorily applied, and it applies to both lessees and lessors in terms of operating leases. It doesn't apply in terms of finance leases. The proposed date for those amendments would be effective for periods on or after the 1st of January 2021. As I say, this has only been released as exposure draft on Tuesday this week. Comments are welcome until the 11th of May, and the FRC says that they're hoping for it to be issued within the first half of 2021. So hopefully by the end of June, it should be able to be applied. Okay, moving on then from thinking about leases, going to have a look at some of the other IFRS amendments that have been issued over the past few months. So the first one we're going to focus on here is amendments that have been issued to IAS 1, IAS 8, and also the release of IFRS Practice Statement 2. So these amendments by the IASB are focusing around the disclosure of accounting policies. So what the IAS 1 amendments change is they move from having, currently we have to just preparers have to propose significant accounting policies. Under the revised changes to IAS 1, material accounting policy information will require to be disclosed. What this is focused on is really around trying to help preparers in terms of the distinction between changes in accounting policy and changes in accounting estimate, and also making sure that accounting policies that are disclosed are providing useful information about how the entity has actually adopted their accounting policies, and avoiding perhaps some of the boilerplating that we see. The change to IAS 8 in supporting that has added a definition of an accounting estimate, which you'll see the definition in the green box on the screen there. And that's again about helping preparers in terms of this tricky area, and making clearer the distinction between a change in accounting policy and a change in accounting estimate. Now, IFRS Practice Statement 2 has also been updated at the same time, so that obviously doesn't have an effective date, and it's had a number of examples added to it in terms of how a preparer might apply the changes to IAS 1 in terms of what is a material accounting policy. In terms of the change to IAS 8, as I say, it's also added some examples in terms of distinguishing between changes in accounting estimates and accounting policies. In terms of the effective date for these amendments, it's the 1st of January 2023, and obviously at the moment these haven't yet been UK or EU endorsed, but it's something to be aware of because this is potentially going to be something that in a couple of years' time we're going to be seeing changes in the level of detail that's disclosed in the accounts, focusing very much on where entities have made specific accounting policies for items. So moving on then to the next area in terms of IASB releases, the IASB has also released some educational material covering going concern and the disclosure requirements related to this. So this isn't obviously a change in accounting standards, but it's about providing some guidance to support preparers, particularly in an area that is obviously currently of high interest to users of the accounts. As we will have seen, obviously the FRC's preparing a thematic around this as well. So it's an area that's going to be under increased scrutiny and has already been for the past 12 months or so, particularly with the significant downturns that have been seen due to the COVID-19 pandemic. We've started skipping through the slides a little bit here. In terms of this IASB educational material, the key elements that are coming out of this is firstly it's stressing the fact that there's a dynamic assessment here of going concern. So it does update for post-balance sheet events. It's under review, and it also helps it helps provide some context in terms of some of the judgments that are being made. Particularly, it focuses on what the disclosure should then be as part of that. So it highlights firstly the specific disclosure requirements from IS1, which is around material uncertainties related to going concern, but it also draws out some of the other overarching IS1 disclosure requirements and how those should be considered as part of going concern disclosures. Firstly, the one we mentioned there on the slide, probably one of the key ones is around significant judgments and the need to disclose significant judgments where perhaps there was a close call in terms of whether or not an entity was a going concern, and explaining the judgment that's been made by the directors of the entity in terms of why they consider that the going concern basis of accounting is still appropriate given other indicators, for example. The guidance also goes on to talk about some other information that users will be interested in and should be covered as part of some of the disclosures in these areas. So including, for example, kind of assumptions that have been used as part of the going concern assessment. I think we've seen quite a shift over the last 12 months of the detail in going concern disclosures. But in terms of those assumptions used, what are those assumptions that have been used, and also an understanding of any consistency of those assumptions with those used elsewhere in the accounts, for example, in impairment testing, etc. That's what I was going to cover in terms of the main IASB updates. I'm now going to move on to touch on a few of the UK GAAP updates that have been issued, as well as the one to the rent concessions. So the first one covers the IBOR reform phase 2 amendment. So we've talked again about this in a previous webinar and the detailed accounting requirements from an IFRS point of view. The FRC has now issued the IBOR reform phase 2 amendments for FRS 102. Unsurprisingly, these mirror very much the adjustments that were made to IFRS, allowing a practical expedient for updates of the effective interest rate without taking a P&L gain or loss. Also adjusting, amending the guidance in terms of hedge accounting and leases as well in certain areas. As I say, if you want to look at some of the details on those adjustments, we have covered it previously from an IFRS point of view, and we'd ask you to listen back to that if you're interested. In terms of the key things that are coming through, and they're similar to the IFRS changes made, these will be applied retrospectively, although there's a choice of whether or not to go back and restate prior periods or whether to recognise that as an adjustment to opening equity. And there's also some specific disclosure requirements as well in terms of the risks around IBOR reform, and also details of how the changes have been applied. Linking into that as well, over the past month or so, the FCA has made its announcement in terms of the end of Libor. So they've kind of formally issued the update now in terms of when that will be ending, and in most instances Libor rates will no longer be available after the 31st of December 2021. There is an exception to that for some of the certain US dollar settings, which will continue until June 2023, and those are all set out in the FCA's announcement on their website. In terms of things to think about this, obviously I just mentioned the FRS 102 updates for phase 2 of IBOR, and the IFRS ones are already, IBOR phase 2 is already in issue for IFRS. It's also been UK and EU endorsed, so it is available for early adoption. Entities just need to be considering the impacts of these on them, and particularly perhaps I think hedge accounting was the one that jumped out at people, was the obvious one where perhaps there was going to be some obvious changes. I think modification of other financial instruments is the other area that entities need to be thinking about, and making sure that they're having discussions with the relevant counterparties in terms of moving across to alternative rates such as SONIA, for example. So just something to have on the horizon as part of your current reporting period. In terms of other other changes to UK GAAP over the past few months, moving on to the next slide, there's also been some amendments made in relation to Brexit. These are fairly, I say, minor wording changes. These are wording changes throughout this whole suite of FRS standards, so FRS 100 through to FRS 105. It's specifically removing references to EU adopted IFRS and instead replacing with references to adopted IFRS to allow distinction for the different entities, be they in the UK or the Republic of Ireland, depending upon which adopted IFRS will be applied. It's also made some changes in terms of FRS 103 to the references to Solvency II directive, as well as a few other changes just to regulations that have changed as part of the Brexit agreement. Carrying on with the theme of Brexit, but moving over across into the IFRS sphere. Over the past few months, the UK Endorsement Board has been kind of fully established, and the board was appointed in March. So the things we just wanted to highlight at this, we just wanted to cover a little bit on kind of what the endorsement regime looks like now in the UK. You may remember previously the UK was using EU adopted IFRS, which were endorsed by EFRAG in the EU. We've now got the UKEB set up, and they will be responsible for reviewing and feeding in on changes to IFRS in the UK and adopting or endorsing IFRS standards for use in the UK. So the chair was appointed back before the Brexit kind of formally happened on the 31st of December. The UKEB website launched right at the beginning of January, and this is a really good website, and this is probably the main thing to take away is if you haven't already visited it, to go and have a look. You'll find on the website firstly updates on current amendments, etc., but also you'll find the full suite of UK adopted international accounting standards are available for free on the website, so that's going to be an important place to bookmark going forwards. In terms of where the board is at the moment, as I say, the board was appointed in March, so they're drawn from a range of backgrounds across both kind of practice, accounting firms, investors, and academics as well. And they're just in the process at the moment of having their statutory delegation of powers. Anybody that signs up to their alerts, you'll see they've been busy in terms of meetings and starting to look at the amendments going forwards. They're just waiting for that formal statutory delegation of powers to go through Parliament. At the moment, the Secretary of State for BEIS is able to approve any amendments to standards as they did with the adoption of the IBOR reform phase 2 back in January. But that's expected to have gone through in April/May. So by the end of May, the UKEB should be kind of fully up and running. In terms of some other Brexit impacts that might have some effect on current reporting periods, the FRC issued some transitional guidance back at the tail end of last year, beginning of this year, around IFRS preparers. So this is going to be relevant for those UK companies that have accounting periods straddling Brexit. So that's going to be both those that have accounting periods over there, and also those with, say, 31st of December 2020 year ends that are not obviously filing their accounts until after Brexit. What this potentially requires is it's going to require some updates to the wording in the current period around the basis of preparation of those accounts, as well as the director's responsibility statement. So you may remember we've covered on previous webinars the fact that obviously after the Brexit date, the UK companies will no longer be able to apply EU IFRS. In that, they'll be applying UK adopted international accounting standards instead. And in that interim period where they're preparing accounts, for example, straddling the Brexit date, EU IFRS is frozen, as it said on the slide, at the 31st of December, with any IFRSs adopted in the UK being applied after that date. As such, in terms of the basis of PREP, the FRC's proposed some changed wording here in terms of what needs to be referred to. So replacing references to EU IFRS with prepared in accordance with accounting standards and conformities with the requirements of the Companies Act. There is also some additional wording that will be required for companies that are subject to the DTR. So that's mostly going to be those that are listed on the LSE main market with a premium listing. There is also some additional complications, for example, where there's securities issued on overseas market, for example. So it's important, if you're in the process preparing your accounts, that you're talking to your relevant advisors around how this might impact on you. That's all I'm going to say in terms of Brexit for the moment. I'm just going to finish my session with just a final change in terms of UK GAAP, which is the issue of FRED 77, which proposes some draft amendments to FRS 101. Again, this is just in the process of exposure draft stage and is expected to be finalised shortly. The main thing to note is there's one additional proposed disclosure exemption from some of the recent IFRS amendments, and that's the disclosure exemption relating to IAS 16. This is covering a sale of items that were produced before PPE is bought into its kind of condition necessary for use. So this is mostly going to be applicable to those that have entities in the extractive industries, for example, where we see this. The disclosure requirement in IAS 16, as I say, there's a disclosure exemption added. There's a few other minor amendments made in terms of some of the references to paragraphs in IAS 1 for some previous changes to the standard there. The other thing I just wanted to highlight was the fact that there's no disclosure exemption has been provided for the IFRS 16 COVID-19 related rent concessions. The reason the FRC did consider that, obviously, as part of this suite of changes, and they concluded that firstly they didn't think there was necessarily a cost benefit given preparation for group accounts, etc., and also it wasn't kind of considered that it would be beneficial for users to not have that information. It was actually providing something quite useful, so that hasn't been added to this to the list of disclosure exemptions in FRS 101. So that brings me to the end of the UK GAAP and IFRS updates. I'm going to hand over to Moses now, who's going to take you through some of the narrative reporting and other updates.
Thanks, Rob. Hopefully you can all hear me, and I apologise for some of the jumping on the slides. That was me and my finger on the mouse. But just moving on to cover the recent narrative reporting developments. Today being Earth Day, we thought we'd start with climate-related disclosures. And again, this has been a sort of an ongoing topic that we've been covering in our webinars. And there's three things I think we just want to cover on this slide. First one is Tcfd disclosures. So premium listed companies for periods beginning on or after 1st of January 2021 will now need to report on their disclosures and whether they're in line with the Tcfd framework. So this is again something for next year's reporting cycle rather than this year's reporting cycle. So if you're a December year end, you're going to have to incorporate Tcfd disclosures into your accounts for next year, but it's something that's worth thinking about now. Again, just a reminder in terms of what the Tcfd framework that covers off 4 areas and 11 supporting disclosure areas, and the FCA has mandated that companies need to report on a comply or explain basis. The 4 areas that the Tcfd covers are governance, strategy, risk management, and metrics and targets, and then they've got the, like I mentioned before, the 11 recommended supporting disclosures. So again, that's just a reminder to get moving on that if you are caused by the requirements. And like I said, it covers premium listed commercial companies. Then, so premium companies listed companies are going to be caught first by having to give Tcfd disclosures, but as you can see in the second column here on the slide, BEIS have set up a consultation widening the scope of or extending the scope of those disclosures to other companies. At the moment, this is just at the proposal stage, and in terms of the companies that might be caught, that's not yet been decided. We've got proposals for large pies with over 500 employees, and or AIM listed companies and other companies with over 500 employees and 500 million turnover. Worth pointing out that the government's plans are to mandate disclosures of the four areas which I mentioned before: governance, strategy, risk management, and metrics and targets. But so it's not on a comply or explain basis. So it's slightly different approach to the FCA. Again, like I said, this is still the proposal stage, so it's a question of watching this space. In terms of when it might become effective, so that's periods beginning on or after 6th of April 2022. So again, you're looking at the 2023 reporting cycle, but again, just something to be aware of. And then the final piece on this slide, the IFRS Foundation at the back end of last year set out a proposal that they should be involved in developing sustainability reporting, a framework for sustainability reporting. The feedback that they got was rather positive. So they're now pressing ahead with those plans to set up a board which would work alongside the ISB. So it's not going to be the ISB board, it's going to be a separate board, but they're looking to develop sustainability reporting standards. Again, at the moment, they're planning on doing this based on TCFD. So we're seeing the TCFD net being widened. And they're planning on announcing their final plans by November 2021 at the COP26 conference, which I've been reminded is the UN Climate Change Conference of the Parties 26. So again, that's something to watch out on, but clearly a hot topic. Sustainability and is clearly something that businesses need to the extent they haven't done so already, embed into their strategic thinking. So BDO have produced a guide. It's a 30-page guide setting out the business case for dealing with climate change, and it contains a lot of information about the link between the climate change and current and future business strategy. It's also got a summary of the Tcfd recommendations for disclosures. So again, if you're planning on adopting Tcfd disclosures this year, it's probably worth a read. And that's broken down between financial sector, industries, non-financial groups, and also gives you some examples of what could be climate-related risks, opportunities, and potential financial impact. So, whether you're going to get caught this year or in the next couple of years, it might be worthwhile having a read just so you can start thinking about this. Moving on now to corporate governance. So no changes at the moment to the UK Corporate Governance Code, but the FRC has put out a publication. It's not a very long read, it's only about 8 pages, where they shared the results of some survey they did, and also giving recommendations for how companies can improve the quality of their comply or explain reporting. In terms of what they found, they found that the explanations given by companies for not complying with the code were, well, they only found 4 out of 74 that they thought were high quality. So they've now set out in this guide how they think companies should approach disclosing non-compliance with the code. And in terms of key recommendations, they're saying, well, make sure you make it easy to find, so don't bury it. In terms of wording, they'd rather people were upfront at the beginning of the compliance statement say we have complied with the code with the exception of provision X or provision Y, and see below for further details, as opposed to where companies sometimes say, well, we've complied with the code except to the extent set out below, and then the reader has to rummage around the report to find the non-compliance. So again, it's all common sense, you would think, but clearly the FRC feels strongly that this reporting could be improved, and they also give some recommendations. So where you have had a departure from the code, they list out 5 things that the companies should do. They urge you to give the context and background for the departure, also to give a convincing rationale for the approach being taken, i.e. the approach that is not compliant with the code. There should also be a discussion of the risks and mitigating actions, because clearly the code sets out best practice. If you're not complying with best practice, is that creating a risk? What are you doing about that risk? Are you intending to comply in the future? Again, the FRC urging companies to state when and if they are intending to comply. And then as a bit of a catch-all, that those explanations should be understandable and persuasive. So again, it's just trying to improve the disclosure of any departures from the code, which clearly the FRC weren't too impressed with what they found. So that's the UK code, which is mainly for premium listed companies. You don't see too many other companies adopting it. But there's also been developments on the weights principles, which again, this was a code, or it's not actually a code. It's principles, which larger companies have been encouraged to adopt following government legislation to widen the reporting of corporate governance to larger companies. So this was basically a review by Sir James Waite, who was the person who came up with this code. And while I think he was encouraged by the uptake and the reporting on the code, found that there were a bit areas that could be improved. And in terms of what he found was that some reports were being written in a way that made him feel that there was a box ticking exercise being done, or a marketing exercise, and clearly the tone of the reports he felt should be more, less marketing and it needs to show that the corporate governance, these principles are being embedded into the organization that's purporting to comply with them. So that was one area for improvement, and another one was quite a simple one. You're meant to be able to have this on your website. Apparently, it wasn't that easy to find on some companies' websites. Moving on to other financial reporting news. So Rob's been speaking earlier about COVID-19, and I think this is more a front-end piece of focus on COVID-19. Strong noises from the FRC that they expect entities to report about how COVID-19 affected them, and in particular, if you took government support, that is disclosed adequately. And the message there is that COVID-19 support or government support is likely to be material by nature, even though if qualitatively you might consider, yes, I took some support, I took a CBILS loan or put my employees on furlough, but the amount of cash that I saved or that I got, that I got was immaterial from a numerical or metric. There's clearly companies should be more upfront as to what they did in relation to government support, and then extending that to, well, what does the future look like when you're doing your going concern presumption? Again, if you are reliant on government support, that should be clear. If you're expecting to be reliant on government support, but perhaps aren't clear as to what support might be available, although I'm not sure that that's going to be a common issue at the moment, then you should talk about that when you're discussing going concern in your financial statements. And again, we mentioned this earlier about whether a material uncertainty exists on ongoing concern, or if the significant judgment was involved to conclude that there wasn't a material uncertainty. Again, that should be disclosed. The FRC did put out some guidance on this in December 2020, so you can find it on their website. And yeah, you should use that as guidance when preparing your 2020 or 2021 financial statements. We're now going to move on again to something else that COVID or coronavirus affected, and this is to do with business interruption insurance. There was a lot of noise in the press as to insurers refusing to pay out on business interruption cases, saying that they weren't their insurance products did not cover COVID. So the FCA brought a test case on 21 types of policy to the High Court. The High Court gave a judgment on 15th of September 2020, which resolved most of the issues, but then there was still some lingering issues as to whether the policies covered them. So the case was taken to the Supreme Court, not the Court of Appeal, and the Supreme Court gave its judgment on 15th of January 2021, which resolved matters, or at least put most of them to bed. So in terms of the financial reporting implications of these judgments, if you did make a claim for business interruption, how do you account for that? So on this next slide, we're going to cover three scenarios, taking an example of a company with a 31st of December year end. So if following the High Court ruling in September 2020, so let's say originally your insurer denied that they were liable, but following the High Court ruling in September 2020, that clarified the insurer's position, and the conclusion was that the claim is valid. Then if you're a reporting entity at 31st of December 2020, you would recognize the asset to the extent that you haven't had your cash yet. If you had your cash, then clearly you will already have banked it. If, however, let's say you filed a claim with your insurer, but even after the first court case, they didn't accept liability, but that was only but after the second court case they did. So again, if you're a 31st of December preparer, you would not recognize that the successful claim in your accounts at 31st of December 2020. You would only recognize it in your subsequent accounts, presumably your December 21 accounts. And this is because of the interaction between IAS 37, which is provisions, contingent assets, and contingent liabilities, and IAS 10, events after the balance sheet date and their equivalents in, I suppose, in IFRS 1 or 2. The standards are the same in both cases, but a favorable court ruling after your balance sheet date is not an indicator that an asset existed at your balance sheet date. And that's why, even though you've banked the money after the year end, if it was only because of the January 21 court ruling, then you're not allowed to recognize that in your December 20 financial statements. And then, if unfortunately you put a claim in for business interruption, but your insurer still denies it after both the September 2020 or January 21 rulings, then you shouldn't be recognizing an asset, and you shouldn't be making a disclosure, because contingent assets you would only disclose when, well, you generally don't disclose them. So moving on now to filing deadlines, and again, all this is all COVID related, they've been extended, but this is just a reminder that Companies House extensions for deadlines falling after 5th of April 21 are no longer automatic, so you need to write to Companies House, explain that COVID is an issue, and then you'll get a 3-month extension. So again, this is going to affect principally, I would think, July year ends. June year ends should still be okay, because their filing deadline should be 31st of March. For AIM companies, again, you can request an extension to 9 months, but it needs to be done by the moment, so it's not automatic. And also, if you're a UK AIM company, you're probably also a PLC, so you would need to request the extension from Companies House, which we've mentioned just before. If you're a main market company, you're still able to claim the extension to 6 months. Now we're going to touch on, again, this is more looking forward rather than effective immediately, but BEIS have had 3 consultations related to Companies House reform. These are now closed. They closed in February. In terms of what they were looking to cover, well, improving the quality and value of financial information on the register, increasing the powers of the registrar, and implementing a ban on corporate directors. In terms of key headlines here, there's a proposal to reduce filing deadlines by 3 months. So if you're a PLC, you'd have to file 3 months after the year end, regardless of whether you are listed or not. And if you're a normal limited company, you'd have to file 6 months after the year end. Again, this might prove challenging, so it would be interesting to see where or how this pans out. In terms of exemptions, small and dormant company exemptions, in the past, there's been no requirement for anybody to certify eligibility for taking these exemptions. There's a proposal that the directors will have to certify, or at least make a declaration that you're eligible. Information to be displayed on the register. Again, this is more a technology thing. Rather than having people search through PDFs of file documents, there's a proposal to increase the use of technology. I presume they mean to do this by tagging, such that you'll be able to see what a document says without having to look into it into the PDF. In terms of increasing the powers of the registrar, at the moment you can just file documents to Companies House and they get filed. There's no querying of the information on them before they get lodged. So there's now proposals that there are going to be new powers for Companies House to query the information that's being filed. Corporate directors, again, this has been on the cards for a while, but there's now a proposal to ban them. So again, that's something to look into if you have corporate directors as directors of your companies. And the final one is a proposal to remove some of the filing options at Companies House. So at the moment you can choose to not include your profit and loss account, or you can choose to do listed accounts. The proposal is to do away with some or all of these options, such that the most detailed accounts that are prepared for members are the ones that you are required to prepare by statute, are the ones that you will file at Companies House. Again, the rationale for this, or given for this proposal, is that it would increase competitiveness and access to finance for for UK companies. So moving on to now what's called here the ESEF, or European Single Electronic Format. What is this about? This is again, this is about using more technology to allow financial information on companies to be more easily accessible. So you've got it there on the screen. ESEF is a format for the electronic filing of accounts. But what this then does is it enables tagging of accounts using iXBRL, which is software extensible business reporting language, and it's something anyway that's coming for UK companies that are listed on a regulated market, but companies that are on a regulated market will now need to prepare these XHTML accounts and then tag them so that the information can be accessed electronically. And in terms of when this needs to be done, so you've got the timeline there at the bottom of the screen. For last year, or at least from periods beginning 1 January 2020, tagging was voluntary, but for periods beginning 1 January 2021, i.e. so for your December year ends this year, primary statements need to be tagged, and that's mandatory. And then from next year onwards, the primary statements need to be tagged, and so do the notes to the financial statements. And in terms of this is just again something else to fit into your financial reporting process, but you know, it's something, again, if you're required to do it, you probably should have started thinking about this already, or probably want to find a provider who will be able to do this for you. In terms of, are your auditors able to do it for you? Unlikely that they will be able to, because of auditor independence rules, at least for public interest entities. In terms of directors' responsibilities, tagging is not about giving a true and fair view. So the director's statement that the accounts give a true and fair view does not extend to the tagging. And it does, again, if you're a listed company and are thinking about your timetable, well, you can probably do this after a version of the accounts have been issued. So there is a deadline for the filing of tagged financial statements, but it doesn't have to be done at the same time as you issue, say, your preliminary announcement, or even at the time you issue your results. And then in terms of the last big topic, there's a base consultation out on audit market and corporate governance reform. I don't think we can do it justice in this webinar. It probably needs a webinar of its own. But basically, this is the combination of the Kingman and Bryden reviews and the CMA's study on the audit market. It's going to cover quite a lot of areas in terms of there's 8 sections in the report. One is expanding the definition of public interest entities. The next one, increasing directors' accountability. The third one is introducing new corporate reporting requirements, also strengthening the supervision. So that's with the creation of ARGA. There's also provisions concerning directors, also changing the purpose of audit and its scope. There's also a section on audit committee oversight and engagement with shareholders. And the final section is a choice of competition in the audit market. In terms of the ones that we've thought, could affect financial reporting, although some of the others also will. So we've got here the bit about the definition of public interest entities, strengthening of internal controls. Again, this is a requirement that could lead to something similar to the Sarbanes-Oxley requirements in the States where directors have to attest as to the controls around financial reporting, and there's also a potential that there may be some auditor certification or assurance required on that. The one on the bottom left-hand corner of this, the square disclosure of distributable reserves, again, there's a proposal that should be included in financial statements. At the moment, there's no requirement for disclosures of distributable reserves to be made. Now, this is potentially quite a complex area in that for a UK company, your distributable reserves are the ones of the company, not the group, but there's proposals to include disclosures about distributability of reserves within subsidiaries. So again, that might be a bit of work. And then the final thing here is an introduction of an annual resilience statement, which is going to build on what, say, premium listed companies already have to do for going concern and viability, whereas this would extend that to a longer term view than both of those. So like I said, this was just a whistle-stop tour on this consultation. We can't do it justice in one slide or one, possibly even on one webinar. The FRC are holding webinars on this consultation, so it's worth signing up to those if you can. And I suspect we probably will do something else in the future on this. So in terms of this final slide here, we've updated some of our guidance, and this is just a list of the ones we've done recently. So our IFRS at a glance document, which again is just a short summary of each standard, but quite a handy one to have, it has been updated. We've got sample IS 34 interim financial statements for March 21, which you might be interested in looking at. But those are all available from our website. The link is there at the bottom of the page and will be in the slides, which we're going to circulate at the end of this webinar. And that brings us to the end of today's webinar. So thank you all for listening, and hope you have a good day.